If you're someone who wants to invest in mutual funds but don't have the confidence, you're really not sure what mutual fund is, how to invest, what are the risk components, what is the minimum that you need to invest in mutual funds, what are the different types, then please watch this mutual fund mega series. What is a mutual fund? So if I'm giving my money to an expert and he's investing on my behalf in the stock market or the debt market, and like me, if there are thousands who are giving their money to this expert who's called as a fund manager, this is called as a mutual fund. Basically, all of us giving our money to an expert and he's investing on our behalf into stock market and other products. This is called as a mutual fund. What is a mutual fund? So now, what are the different types of mutual funds? Broadly, there are two types: equity fund and debt fund. Most of us associate mutual funds with only equity, but there is also a debt fund. Now, what is an equity fund? If the fund manager is investing on your behalf in the stock market by buying shares of listed companies, this is called as an equity fund, right? The investment is on the stocks or equities. For debt fund. Now, what is an equity fund? Similarly, if the fund manager is investing your money in bonds, right? Corporate bonds, government bonds, or any instrument that is giving interest, these are called as debt funds. So in equity funds, you are getting investments into equities, and in debt funds, you're basically getting interests. So similarly, if the fund manager is investing, the next question is, what is the minimum amount that I need to invest in a mutual fund? You can start anything between 500 or 1000 and you can invest in mutual fund. One of the biggest advantage of investing in mutual funds is the small token amount, right? So anyone can invest in mutual funds. And the next question is, what are charges, right? Everything has charges. Now in mutual funds, it is called as an expense ratio. And this is the fee that we are paying for the fund manager, and the complete package that comes with the fund manager, you're paying for it. So usually equity fund has an expense ratio of 0.5 to 2.5%. Debt funds, on the other hand, has an expense ratio of 0.5 to 2%. So one of the factors of selecting a mutual fund becomes the expense ratio. You want to invest in expense where the expense ratio is lesser. Now let's understand why we need to do that. So let's assume that you have given your funds to an expert, the fund manager, and he has invested on your behalf into a mutual fund. So basically, he's invested into stock market and other instruments, and over the year he has generated a return of 14%. Now, is that what you're going to get? The answer is no. So here the fund manager is going to deduct the expense ratio. So the expense ratio is around 2%. So 14 minus 2 is 12%. So 12% is the net return that is passed on to you. So whatever the return the fund manager makes, he deducts the expenses, and after that he gives that to you. So here the fund manager is going to deduct the expense. Now the next question is mutual fund regulated? Yes, mutual fund is highly regulated. It is regulated by SEBI and also managed by AMFI. So SEBI's main objective is to protect the interest of the investors. They have various policies that they form, right, and various guidelines that a fund manager has to follow. And because of this, mutual funds is a very secure sort of an investment, though it is very risky, but the way it is managed managed in a very systematic way. What are the different categorization of mutual funds? What you have understood is it's broadly into equity and debt. Now under equity, what are the categorizations? So based on the market capitalization, basically the size of the company. So based on the size of the company, they have classified into large cap, mid cap and small cap. What are the different categorization of mutual funds? Large cap are the top 100 companies in India based on the market capitalization, and these are all listed companies. The next is mid cap. It is based on the ranking 101 to 250. These are mid cap companies. Small cap are the next. Anything onwards, 251 onwards, they are the small cap. So the mutual funds, the categorization is all based on the company size. So obviously, if you are investing in large companies, your risk will be less compared to small companies. Similarly, large cap are less risky compared to small and mid cap. It is based on the ranking 101 to 250. Now, similar way, what are the categorization of debt funds? Debt funds is all about investing in bonds, right? It can be corporate bonds, government bonds. Now, bonds, the entire game is about the duration, right? The lower the duration, the less will be the risk, and less will be the returns as well, or the interest. So here they're categorized as liquid funds. If the duration of the bonds in which the fund manager is investing overall on average is less than 3 months. So this is called as liquid funds. Similarly, in ultra short term bond fund, here the duration of the bonds will be less than 1 year. So whatever the fund manager is investing, the duration of the bond on average should be less than 1 year. Now short term income funds, here the duration is 1 to 3 years. Long term income funds, here the duration is 3 to 10 years. So debt funds is all about duration. So the lesser the duration, lesser will be the risk as well as the return. Higher the duration, higher will be the risk and return. That's it. Thank you for watching. If you found this video helpful, please give a thumbs up and subscribe to my channel. And let me know in comments if you need any topic for me to simplify for you. So until next time, take care and happy simplifying.